Welcome to the Political Risk Podcast, where geopolitics and specialty insurance markets meet. This episode is about mobilising capital, credit and political risk insurance, and the future of global investment. I'm your host, David Benyon, and I'm privileged to be joined by Rafael Docavo-Malvezzi, Global Chief Underwriting Officer for Political Risk, Credit and Bond at AXA XL. Rafael also serves as Vice President of the Berne Union, the non-profit association that represents the global export credit and investment insurance industry. He was appointed to his present role at AXA XL in June 2021. Before that, joined its New York office in 2011 as Head of Risk Management for the insurer's political risk, credit and bond portfolio. Rafael previously worked in risk management positions at QBE Americas and Exporters Insurance in New York. Before joining the insurance world, he worked at MasterCard International, where he held various roles in strategic planning, operations, and risk consulting for MasterCard advisors. He also worked as an international economics researcher at the Council on Foreign Relations in New York, and as a statistical analyst at the OECD in Paris. In this episode, we'll talk about AXA XL's credit and political risk portfolio, as well as Rafael's role and background, where we are in the credit cycle, and managing long-tail business amid a changing risk environment, and mobilising capital, development finance, and growth opportunities. Okay, right. Let's get into it. Big thank you, Rafa. Welcome to the podcast.
Thank you so much.
Before we get into market themes, could you give listeners a sense of your current portfolio you work with at AXA XL? What sits within political risk, credit and bond, and how is the book broadly split between credit non-payment, PRI, and other areas?
So we cover, generally speaking, three types of very broad risk categories. The PRI one is if you want, the pure political risk, political perils, the ones that perhaps you're more familiar with. We cover political violence, confiscation, expropriation, arbitrary actions by foreign governments or host governments. That includes also perils like forced abandonment in case of a conflict, or mandate by the government. We have embargoes, strikes, riots, civil commotion. So it borders a little bit the political violence aspect as well. And then we also cover currency convertibility, that is the repatriation of benefits for the insured, or the inability to convert currency into foreign exchange, right? So it can be a pretty wide suite of perils covered, usually for large corporates, traders, but generally a fairly large corporate, multinational type of insureds. We write a little bit less than we used to. For us, is around 15% of our book. And then the largest part is the non-payment cover. And that really covers a very wide variety of transactions. Most of our insureds are either commercial banks or large financial institutions, as well as the official finance sector. So you have the multilateral development banks, the DFIs, development finance institutions, development agencies, export credit agencies. Those are a big and growing part of the insured base. So that's really the non-payment part, and it can cover really a very wide variety of transactions and risks, from traditional export finance to, project risk, infrastructure. We also do more and more mobile asset finance, what we call mobile assets, which is essentially aircraft and shipping finance. And then the third part is the commercial surety. So the bond part is actually our commercial surety business. In the case of AXA XL, is at the moment circumscribed to North America. So it's very much a North American business, really focus on the commercial surety side of things rather than the large project surety, which is the remit of a lot of our competitors in the market. But that's basically our portfolio, our breadth of coverage at the moment.
Let's talk about your route into this market. Obviously, your career path brings together economics, international relations, analytics, risk management. Do you want to just talk us through it before we go any further?
Yeah, in many ways, I was a bit of a jack of all trades. I was interested. My background was originally actually in computer science. Then I took a liking for international finance, economics, development finance. And that's what took me to the US to further my education. And I think for many people, especially the earlier generations in the political risk and credit insurance market, a lot of us came into the market by happenstance. Either we had someone who worked there, or we referred us to a company that could have been interested in our profile. That's what happened to me. Essentially, someone I knew was working for the small export credit insurer, very, very niche, monoline. And they said, well, they seem to be looking for someone interested in developing the risk management function. And I went in. That was 20 years ago. And then the love affair began with this business. Today, it's a more, let's say, visible market. But 20 years ago, it was still very, very niche and not exactly the first thing that comes to mind when you speak of insurance. It kind of fit my profile. I knew about, as you mentioned, this intersection of international affairs, credit analysis, economics, a real interest in global affairs and finance, and yeah, it's thankfully worked nicely so far.
Glad to hear it. Yeah. So let's move back to talk about AXA XL then. AXA XL is building a dedicated risk and analysis capability alongside underwriting. So how does that analytical function shape the way that you underwrite?
I mean, this particular aspect is what actually brought me to the industry, and it mirrors maybe a little bit our market, which is more the what we call the medium and longer tenor single situation market, as opposed to the more traditional, more established short-term trade credit, where you had commercial underwriters and credit underwriters. So you had market facing people, and then you had the underwriting part that did more the credit analysis, the limit management, things like that. So the idea here was to expand that concept into our market, which is expanding, and it's encompassing more and more different types of risks, different types of structures. It's not exactly like in a bank where you have the bankers and then you have a credit department sitting in the background telling you how much or what you can do. Here, it's a little bit more of an integrated function where the idea is to get a consistent, in-depth, independent view of each risk, of each transaction, and but accompany the underwriting process so that it's really as well informed, as consistent as we can make it, given the complexity, as I said, of the risks that we see today. So, very much part of underwriting, it's really to make sure that we have analytical rigor, a second pair of eyes, if you want, in each transaction. And really, ultimately, the underwriter makes the decision, but the idea is they make a decision with a very broad and deep view of the risk at hand. And then this function also obviously helps me now to manage the portfolio, to understand aggregations, to report out those aggregations into the company, to shape our underwriting strategy, our risk selection, our risk appetite, and have this continuous loop that informs, our knowledge as we journey into the business. It really started as I started. I came, like I said, into this industry, opening a credit, or if you want, a risk analysis function, several iterations after, and in a much larger organization, we have a quite substantial group that works hand in hand with the underwriting units across the world.
Where are we in the credit cycle? Or are we in something new entirely?
Well, that's one of the very, very core questions as we think about strategy, where to take the business, where are we going collectively. But I think that one of the questions that I've been asking myself for quite a bit, and I get those questions from clients, from reinsurers when we discuss the business, is there a credit cycle at all? I think that for those who have been around for a bit like me, may remember a traditional credit cycle. You get an expansion, growth, rates go lower, and then you expand, and then defaults begin to occur. There's a recession, interest rates tightened, and then you contract a little bit, retract, and then you expand again. So I think today, especially since the global financial crisis, what you have had is a massive amount of monetary and fiscal stimulus that to avoid obviously a bigger crisis at the time. And then you obviously had COVID that also represented a massive injection of liquidity as well as fiscal stimulus. So I think in many ways that has, if you want, how would I put it, flattened or anesthetized the
Yeah.
credit cycle a little
Does
bit.
it stretch things out, distorted things?
Yes, and in part is okay, it's been great. The default levels have been quite subdued for a long time. So for many, obviously, it's a happy circumstance. But at the same time, it's driven rates and premium rates much lower, as you can imagine. So liquidity comes in. Obviously, there is abundant cash or other forms of financing available. And in our market, we're not immune to that. So competition increases amongst the market participants. There is new capital coming in. And therefore, although losses have been generally benign, I would say, on the other hand, risk pricing is, I would say, at times compromised. So you're in this area where, you really have to think carefully about not getting too pulled in too much into relaxing covenants, more general lending that could be seen as not structurally sound, what happens at the time of a default, what type of recovery you can get, where you stand in the credit hierarchy. So those are big questions that we ask ourselves. So to your question, when we think about portfolio shaping is really to avoid excessive aggregations in the stacking of capacity to any particular name, any particular group, any particular industry or project. And really, the key is as much diversification as you can get, but also thinking a little bit what is your client base? Do you want to offer your capacity to everyone that knocks at the door? Or do you want to work with the established customers and the clients that you think are really practicing sound underwriting themselves? Are they prepared to manage difficult situations where would you have a potential default or a potential loss? Those are really the very relevant questions. If there is a cycle, I would argue at the moment it's very difficult to say. I think we're much more prone to big volatile episodes where everything goes well and all of a sudden, be it private credit, being this or that, can actually generate a very sensible correction. And I think that's kind of also the event or the scenario that you have to be as prepared as you can for, in the sense that if there are corrections in the credit cycle, they could be quite sudden and quite brutal. And that's the type of event I think that we need to be thinking about when we think about credit insurance and credit exposure in general.
Yeah.
That is.
I mean, some of the risks that the policies in your lines of business, I mean, they transcend the credit cycle because you've got 10, 20, even 25-year policies, really multi-year projects. How do you underwrite with that kind of time horizon in mind, especially for something like complex energy or infrastructure projects?
Yeah, you have a variety of risks there. But if we start with the infrastructure, if you want, whether it's energy, renewable energy, large transport hubs or petrochemicals or things like that, very sizable projects, I think first and foremost, it has to make sense. So you have to do your due diligence in terms of what are the assumptions around it. Do you have the right players, whether it's the contractors, the sponsors, and obviously the people behind the institutions financing it? I think maybe counterintuitively, the riskiest part for a lot of these projects is at the beginning. So it's when the project gets going, you have a construction phase, you have to get things in order, and then it comes online. And then you have to see whether your assumptions around cash flow actually prove to be right. If that is the case, then you have a functioning project that generates revenue, and it should hold. What could happen is then, you have more political type of risks where a government may change rates or the PPP terms when you talk about energy or energy generation projects. But otherwise, purely financially or economically, that project, once is on, it's on. And what happens in a lot of, when you, like us, we cover the debt or the financing, is that those things will refinance. So you have to put terms, yes, for a very long time, 15, 20, 25 years for some renewable projects, just to cover, just to give certainty to our client that they have coverage for the duration of the facility of the loan. But in the end, the most likely outcome is that you won't see those risks run the whole period that you underwrite for. And then you have the likes of, like I said at the beginning, mobile assets. So if you have aircraft finance, shipping finance, those usually go to 10, 12 years typically. But there you're basing your underwriting also on the asset, right? So you have a liquid asset, say a new Airbus A350, that should have a good market. Should things go wrong, the airline defaults, something happens, then, the value is in the analysis of the asset itself and its, let's say, durability in terms of value along that policy period, if you want. And then obviously you have amortization. So your exposure, it peaks at the beginning and then it starts amortizing over time. So you have to think also in those terms. You're not going to be exposed for the full limit for decades.
As you'd expect on this podcast, focus on political risk, and that tends to focus on confiscation risks as well as obviously talk a lot about war and political violence on this podcast. The lion's share of your book is credit non-payment. What does that part of the market look like today? How diverse are the risks in it? And from previous conversations, I know there is a fair amount of overlap, geopolitical or otherwise.
Yeah, I think on the note, of course, your podcast is more on the political risk aspect. I mean, we should not forget that even if we cover non-payment for a lot of those transactions, I mean, many of them are in emerging markets. There's always a political risk element, even though you're not covering exactly those types of risk, but there's always that, if you want, the legal framework, the operational framework, things like that. So it's not totally divorced at all. And one would argue today, what is definition of an emerging market? I would say legal uncertainty has come to many shores that before we wouldn't have suspected. So you have to think about political risk in every transaction, even if you're covering essentially non-payment. And obviously, we also have the part where we cover sovereign-backed projects. So a lot of emerging markets, these projects are guaranteed by the sovereign, by the government. So you have to think about, obviously, the political components, the solvency of those countries, the ability to maintain that promise to pay those loans, those facilities. So there's political risk at every single transaction we write, even if it's not labeled strictly as PRI. So having said that, the market is growing very fast. And in a way, it's a great thing that we have accomplished, I think, collectively, brokers, clients, insurers, reinsurers, to really expand the breadth of our product. Because when I joined the industry 20 years ago, the coverage really was a fraction of what can be covered today. Certainly project finance, this asset-backed finance is relatively recent, I would say in the last 10 years. And also, that's all been thrusted by also regulatory aspects. So a lot of, for example, when you talk about private commercial banks, a lot of the shift has moved from pure limit management, which was a lot of the reasons why they originally came to the market, just because they're full on certain names, certain countries. They were interested in getting an insurer to provide them cover for a portion of that exposure so they could manage their aggregations or maybe could lend more to the same client, right? But over time, there's been more and more an emphasis on regulatory capital. So the banks have had to face more stringent capital management, capital indicators. So our product has proven to be effective as well in managing that. So if, for example, a AA rated insured like ours takes a portion of that risk, then the bank gets a nice credit, if you want, on a capital allocation basis because they're backed by strong insured. So over time, that has helped open, if you want, the door to within a lot of the banks to not just export finance, but a lot of the other departments. And today we've seen also, our product used for general corporate lending, for commercial real estate, finance, for derivatives, a lot of a very broad range of credit exposures. And similarly, some of that has also transferred to the multilaterals, the official lenders, multilateral development banks, where they're being more and more a challenge to deploy their capital, deploy their capabilities, and they've turned to the private market to use our capacity, risk-bearing capacity, to support their lending as well. So it's been a nice story of really expansion of the usage of our product, and more, if you look at the stats, some brokers put every year a report on the credit and political risk market. You will see the number of providers, the capacity available has grown very significantly over the years.
So, thinking about mobilizing capital, development finance as an area of opportunity, just growth opportunities in general. Where do you see the biggest growth opportunities, and how can the market step up to meet them?
There's certainly been growth opportunities in the breadth of the risks that the market can now cover. A lot of players, some players are very, very open to agnostic to the type of risk. Others prefer, like us, concentrate on certain areas. But I think in general, the reality is that no matter how complicated the geopolitical environment may be, there is a very significant trade and foreign direct investment financing gap. That's been the case for years, and that continues to be the case. And I was looking at some stats, for example, of the Berne Union, which is the industry association for credit and guarantee providers. So it encompasses not just private insurers, but also the official sector, ECAs and others. But we basically cover barely 13, 15% of global trade. So there is a lot of space there to continue to be effective or continue to contribute to what I think is an appealing aspect of our product, is to really support true commercial activity that foments hopefully prosperity, economic growth, and an increased investment, particularly for countries where perhaps access to finance is still quite challenged, or at times when capital markets are still very shallow. Large names can finance themselves, but then how do you get to those projects that are bankable in theory, but cannot get access to financing? And I think that's a very interesting area where we continue to be helpful and supportive, and also in breaking some silos. I think today still development finance is, say, one is by the UN sort of consensus around sustainable development goals, things like that. Well, the multilateral institutions play. You have the OECD rules that govern, export credit agencies. So I think there's still some silos that need to be broken so that there can be really an amalgamation of all the different sort of financing entities and financing capabilities that are available. So I
Yeah.
think that frontier still needs to be explored, and really, I mean, the need is so vast that the mobilization mandate for a lot of these institutions is to really get the public-private partnership to really work and be leveraged to maximal capability. And that is one area where I think the growth potential is there without a question, but it takes, and it will continue to take, a lot of dialogue, a lot of breaking barriers, a lot of collaboration, especially at a time when collaboration may not be the most, let's say, in vogue concept. And now it's then investment tend to be a little bit more bellicose, if you want. So it's really, for us is to work with the industry, but also with our multilateral partners, with regional development banks, with development finance institutions, to really prove that we can mobilize quite a bit of risk-bearing capacity. Our challenge is that we are not originators, right? We take the risks that are presented to us, and do the best we can. So in the end, is really to hopefully help our clients, our insureds, to really originate and then distribute those opportunities across the market.
Mhm. The recurring conversations about how to bring private capital into markets, projects that otherwise sit beyond investors' appetites for risk. How can PRI and CPRI continue to play a bigger role in making those risks more palatable for banks and for other institutional investors?
I think it's important to distinguish a couple of things. If a project is not sound, we're not there to make questionable risk good. I think it's important that the concept of partnership. And in that sense, I think particularly when you think about, again, going back to the mobilization of private capital, a lot of it has to do more with precisely the trade and FDI gap, especially for a lot of developing economies where, investors, institutional investors who have the big investment potential, usually they're not comfortable in taking single B, double B rated countries or double B rated types of transactions with which we can be perfectly comfortable, right? So I think really the core part on the mobilization aspect is how do you first of all break those silos so you can bring together the private players, so the commercial banks that originate or the multilateral institutions that also originate some of these transactions. How do you distribute those in an efficient manner? Because we can take one risk at a time, one project at a time. We have done quite a bit of that. But really to mobilize, let's say, on a portfolio basis or in a programmatic basis, these types of risks, so that then through a combination of donor capital, multilateral institutions, and then private insurers can together put, if you want, a portfolio solution or a structure that then in turn can be presented and said, hey, the underlying are all these types of different projects, different financings into these markets. But given the structure presented and the insurance layer, then it is a well-rated project that then, or a well-rated portfolio that institutional investors can then participate in. And you may have seen it. I mean, we have in very recent, in the last couple of years, AXA XL has been part of some of the very interesting placements. There have been some syndications, some securitizations with the IFC, the International Finance Corporation of the World Bank, with the Inter-American Development Bank, and EBRD most recently, where now there are these programmatic or these securitized types of solutions where the insurers take a layer of that risk and then that gets distributed to institutional investors. So it's happening. It's just a matter of really how can you get more momentum, get more nimble in structuring those projects. But I think the direction of travel is good, and there's a lot of interest in our market to support those types of deals.
So is that how we go about this? Is it those EBRD type collaborations, PPPs, in order to have a multiplier effect? How does that work in practice?
Well, I think collaboration is inevitable because there is no single institution that can carry the load, or a group of institutions. When you look at the world, I mean, the contributors, the large contributors today are not going to volunteer more and more and more capital. They have to operate within their current constraints. They can only deploy a certain amount on their own mandates, on their own capital capabilities. So they need a multiplier effect. And that's where we can step in as private institutions to become that sort of leverage, if you want, that multiplier effect that can, for every dollar of capital that one large MDB or regional development bank can deploy, then maybe there's 5 times that available in the market to make the quantum much more considerable. I think that's definitely the direction of travel if you really want to make a dent in that financing gap. Otherwise, everyone can go their own way, but I think especially in the moment, collaboration is the key. Blended finance, there's been quite a bit of work we've done institutionally as well with other players in the same space to really, if you want, bring down the barriers, find solutions that work, collaboration across different institutions, and then hopefully replicate. Once something works, I mean, it's interesting because we started programmatically with the IFC a number of years ago, and now a lot of these institutions want to replicate what was done then. And that's a good thing. Ultimately, people take note on what works, and then you hopefully are able to replicate that model and make it more and more efficient so the time to market is can be faster. And that's a very interesting journey because you have to think beyond, obviously. First and foremost is working for our shareholders or our company, but ultimately it takes really a collective industry effort
Mhm.
to make a difference.
Yeah, well, maybe that's part of the answer to my next question. Just again, looking ahead, but perhaps with an introspective focus. So you mentioned words like collaboration there. Well, what in your view needs to change for the credit and political risk insurance markets to play a bigger role? Change within the insurance market itself. Is it that product innovation around blended finance, that kind of thing, more collaboration, more PPPs, more involvement with multilateral? But from
Yeah.
looking inwards, what do you think needs to change within our insurance markets?
I mean, the direction of travel, based on what I told you, has been, I think, in general, quite positive. We're more and more relevant. There's a lot of capacity that has come into our market. Obviously, that in part is driven by the search for, if you want, alternatives to what is generally a softening market in the P&C general insurance and reinsurance world, which is fine. We welcome the attention, but hopefully it should be beyond those specific, if you want, shorter term needs that originate from the insurance market cycle. So you want to be there not just because you can provide counter cyclical good results, but really to be as an established entity. And I think if we look to ourselves internally, inwards, for us, I think it's the continued work with our respective managements, with the industry, with the regulators, to really give comfort that, yes, it's a business that looks risky because we take credit risk, not insignificant. But actually, if you do it right, if you partner with the right insureds, with the right clients, you are building a very interesting stream of earnings over time that, with, knock on wood, good underwriting and the right partnerships, we can really deliver very consistent and very attractive returns. So it's really making our respective management in all the companies, our insurers as well, and generally the broader insurance community more comfortable with the risks we take, have conversations about capital deployment. So how much capital should be allocated to our business? How do we further and further refine the understanding of the product to say it's a good one, it's worth investing in it, it's worth putting the talent and the resource to see it grow. And it has grown. It's good, but it takes work. And we've seen players in the past that have come in and exited the market. If you get a bad run, God forbid, a global financial crisis or some big event where you get increased defaults and losses, then it's really to have the staying power to say, hey, the world is not ending. We would pay the claims that we need to pay, but actually we have a solid foundation in place to continue to deliver good results. And I think the attractiveness of the types of risks that we cover, we are quite relevant in the sustainability front for those companies and those entities that are really committed to that. We are a very appealing line of business that is very active in that energy transition and other areas where sustainability, like I said, we have interesting, debt for nature type of transactions. So I think the more the education we can provide, the understanding about a product, the analytics and the appropriate data to really value the portfolios and the diversification we bring and the strong earnings and hopefully profitability that we continue to generate, it makes for then this is no longer that much of an exotic line of business. but really one that is here to stay and has potential to grow in a thoughtful manner and be more and more relevant in a variety of fronts, like I just mentioned, but fundamentally for the benefit of our own shareholders, which is ultimately who we work for.
Of course. Rafa, it's been fascinating talking to you. Really insightful. Thank you. Thanks for being on the podcast.
My real pleasure. Thank you, Dave. I appreciate the invite. Really, really an honor to be with you today.
And that just about wraps up this episode. I'd like to thank my wonderful guest, Rafael Docavo-Malvezzi from AXA XL. Thank you for listening, and do tell your colleagues about this podcast. Like, subscribe, leave a review, that kind of thing. And of course, please do tune in again. I've been your host, David Benyon. Production was by Ned Sedgwick, and Lawrence Durkin made the music.